All right, so we're back, and we're talking about accounting theory.
Yeah, it's really fascinating stuff.
It is. It's like really making me think about how like the business world is changing so rapidly.
Right.
And how does accounting keep up?
Yeah, how does the theory adapt
Yeah.
to these new challenges?
And the text actually brings up this point, like
Okay.
it doesn't necessarily give all the answers,
Yeah.
but it definitely highlights some areas
Okay.
where we need to be thinking about this.
Yeah, like what?
But one big one
Yeah.
is intangible assets.
Oh, yeah, those are tricky.
Yeah, you know,
How do you value like a brand?
like a brand or a patent or
Right.
copyright.
Goodwill.
Yeah, goodwill,
All those things.
like things that don't have a physical form,
You can't touch it.
but can be worth like a ton.
Right, it's not like inventory you can count.
Right, exactly.
So how do you put a number on that,
Yeah,
on a balance sheet?
and especially in the digital economy.
Yeah, it's becoming even more important.
Like so much of a company's value
Mm-hmm.
is in its like intellectual property.
Yeah, like software or
Yeah.
algorithms.
Algorithms, yeah, like how do you even begin to measure that?
Right, and that's where like traditional accounting frameworks,
Yeah.
they struggle.
Yeah, they're kind of.
Yeah, they weren't really built for this.
Yeah, they were built for a different time.
Right, when it was all about
Yeah, factories
factories and land.
and equipment.
Exactly.
Yeah.
So we need new ways of thinking about this.
So do we need like a whole new accounting language
Maybe
for the digital age?
it's possible.
Yeah,
I mean, some people are talking about like fair value accounting.
for intangible assets.
Yeah.
Okay, so instead of like historical cost, we're looking at
What's the market value?
what's the market value
Today for this
Right.
intangible asset.
Yeah,
Okay.
but isn't that kind of subjective?
Well, it can be.
Yeah.
And that's one of the criticisms of fair value accounting.
Yeah.
It's like, how do you really know
Yeah.
what the market value is?
And couldn't it be manipulated?
It could.
Yeah.
And so that's why it's important to have robust valuation methods
Okay,
and safeguards in place.
so that people aren't just like
All right.
making up numbers.
Yeah, you need to be able to justify your
Yeah.
valuations.
But I guess the argument is that like
Yeah.
if we don't do this,
Yeah.
we're not really capturing
The true value
the true value of these companies.
of a company.
Yeah.
Yeah.
Like especially if their main assets are intangible,
Right, exactly.
like we're underrepresenting.
Yeah, it's like looking at a tech company
Yeah.
and only valuing their computers,
Yeah.
but not their software,
Right.
which is where the real value is.
Exactly.
Right.
Yeah.
So it's a challenge.
It's a huge challenge.
Yeah.
And it's really where I think like accounting theory needs to like step up.
Yeah, we need new concepts, new principles
Yeah.
to guide us in this new world.
Yeah. And like maybe even new language.
Yeah, new ways of thinking about it.
Yeah, it's not just about numbers anymore.
Right. It's about
It's about ideas and concepts and
value.
value.
And how do you measure that?
Yeah.
That's the big question.
It's like we're at a real crossroads.
Yeah.
Like the old ways
They don't quite work anymore.
don't quite fit.
Yeah. We need to evolve.
Yeah. And it's both scary and exciting.
It is.
Yeah.
Because it's an opportunity
Yeah.
to really shape the future.
Yeah.
To reshape how we understand business.
Yeah. And how we communicate about it to
Yeah.
investors, to the public.
Yeah,
It's a big responsibility.
it is.
Yeah.
So speaking of different approaches,
Yeah.
the text also talks about like the authoritarian approach.
Oh, yeah. That's a different one.
Yeah, it's very different from the pragmatic approach.
So instead of looking at what's happening in practice,
Yeah,
this is about
like
Ru-
rules,
yeah.
standards,
standards set by,
authoritative bodies.
yes,
Yeah.
like the FASB,
FASB, yeah.
the Financial Accounting Standards Board.
Yeah. Or internationally, the IASB.
Right. They're the
So
ones who decide.
they set the rules
Yeah.
and everyone has to follow them.
Exactly.
So it's kind of like a top-down approach.
Yeah, it's very top down
Yeah.
instead of bottom up.
Okay. And what are the arguments for that?
Well, one of the big ones is consistency,
Okay.
comparability.
So that everybody's doing it the same way.
Exactly.
Okay. So that when you're looking at two different companies,
Yeah.
you can actually compare them.
Yeah, you're comparing apples to apples.
Apples to apples, exactly.
Not apples to orange.
Right, because if everyone's using their own methods,
Yeah,
it's
yeah.
chaos.
Yeah, it'd be impossible
Yeah.
to like make sense of anything.
Yeah, to make informed decisions.
Yeah.
As an investor,
Yeah.
as a lender, as anyone
Yeah.
who's using this information.
So there's a real need for like
Standardization.
standardization.
Okay.
And the text gives an example of this.
Oh yeah, what's that?
The shift from market value to fair value for investments.
Okay.
And that was driven by,
Standard setting bodies.
Yeah.
Like FASB and IASB.
they said, hey, market value,
It's not always.
pretty misleading.
Yeah, it can be volatile.
Yeah.
It can fluctuate a lot.
Yeah.
And so we need something that's more
Stable.
stable.
Yeah. And that reflects
Yeah.
the true value.
Yeah, the underlying
Yeah.
economics.
Economics of the situation. Okay, so that's a case where, like,
Yeah.
the standard setters
Stepped in.
stepped in and said,
This is how we're going to do it.
yeah, we need to make a change
Right, to
Yeah.
keep up with
to keep up with the times.
the changing times.
Yeah.
The evolving business world.
But doesn't that also kind of create a problem?
Well, it can,
Yeah.
because sometimes those standards,
Yeah.
they can be too rigid.
Yeah.
They can be too slow to adapt.
And they can stifle innovation.
It can.
Yeah.
Because if everyone has to follow the same rules,
Yeah.
it might prevent people from coming up with new and better ways of doing things.
So it's like a balancing act.
It is. You need the consistency,
Yeah.
but you also need the flexibility to
Mhm.
adapt.
Yeah.
And that's the challenge.
That's the ongoing tension.
Yeah, it's a constant tension in
Yeah.
accounting.
It's like walking a tightrope.
It is. You
Yeah.
don't want to fall off on either side.
Yeah. You need to find that sweet spot.
Yeah.
So the text also mentions a few other approaches,
Okay.
like the sociological approach,
Yeah.
the economic approach,
Uh-huh.
the event approach.
What are those all about?
I think those might be like,
Maybe another deep dive?
yeah, another deep dive for another day.
Okay, we'll save those for later.
Yeah, we'll put a pin in those.
Sounds good.
But for now, I think it would be helpful
Yeah.
to maybe delve a little deeper
Okay.
into some of these specific concepts.
Yeah. Let's look at some examples.
Yeah, like we talked about CPP.
Constant purchasing power accounting.
Yeah.
Right?
But maybe we can like actually,
Break it down.
break it down a little bit more.
Okay.
So just to remind everybody, what is CPP all about?
So CPP is basically trying to adjust for inflation
Oh, wow.
because $1 today
Yeah.
is not worth $1 tomorrow
Or yesterday.
or yesterday.
Yeah.
So how do you compare financial statements
Yeah,
from different periods?
when the value of money is different.
Exactly.
Yeah.
So CPP is trying to solve that problem.
Okay. And how does it do that?
So it uses a general price index
Okay.
to adjust the numbers.
Okay.
So you're basically restating
Yeah.
the historical cost figures in
Okay.
terms of current purchasing power.
So it's like
So you can actually see,
translating.
translating, like, what did this really cost?
Yeah. What did this actually mean back then
in today's dollars.
in today's dollars?
Right.
Yeah.
Yeah, that's the idea.
And the text has this great example
Okay.
where they actually walk you through like
Ah.
a company's balance sheet
Okay.
and how they adjust.
The numbers.
Yeah, for inflation.
Interesting.
And it's really eye-opening
Yeah.
to see like how much
How much of a difference it makes.
inflation can distort
Yeah.
the numbers.
Especially over long periods of time.
Yeah.
Yeah.
If you're not adjusting for it,
Right.
Yeah.
You're comparing apples and oranges.
yeah, you're not really getting
You're not getting the true picture.
Get your picture.
Yeah.
Okay, so CPP helps us with that.
It does.
All right, and then another concept that I thought was really important
Yeah.
was current value accounting.
Oh, yeah.
So
CV.
ECV, this is about
like
using current values
current value.
instead of historical costs.
Yeah.
So it's kind of like what we were talking about earlier with
Yeah.
intangible assets.
Yeah.
But this applies to
Analysis.
all assets and liabilities.
Yeah.
So everything on the balance
If
sheet,
we're going to have a balance sheet.
we're trying to measure it
Yeah.
at what it's worth today.
At its current value.
Right.
Okay.
And there are different ways to do that.
Yeah. The text talks about
Four main concepts
four main concepts
of
of.
current value.
Yeah. Can you remind us what those are?
Sure. So we have net realizable value,
Okay.
replacement cost,
Uh-huh.
value in use,
Yeah.
and fair value
Mm-hmm. Okay. And each one kind of gives us a different
perspective.
perspective on what something is worth today.
Yeah.
So net realizable value
Is like what you could sell it for
today.
today minus any selling costs.
Exactly.
Replacement cost is what it would cost to replace it
With a brand new one.
with a brand new one.
Right.
Value in use.
Is the present value of the future benefits
Yeah.
that you're going to get
From using the asset.
from using the asset. Okay. At fair value,
Is the price that you would receive to sell an asset or pay to transfer a liability
okay.
in an orderly transaction between market participants.
At the measurement date.
Yes.
Okay. So it's really like
It depends.
in the
On
situation.
the asset,
Yeah.
what method you use.
Right.
Yeah.
And it requires judgment.
Yeah.
Choose the right one.
It's not just like a plug and chug
Uh,
formula.
You have to think about it.
You have to think about it.
Yeah.
Okay. And then they also talk about how this ties into
Capital maintenance.
capital maintenance.
Right.
Which we talked about before.
Yeah. Those different concepts.
Different concepts.
Money capital, purchasing power, capital, physical capital.
Yeah. So how does that all fit together?
Well, all depends on how you define capital and what you're trying to maintain.
Yeah.
So if you're using the money capital maintenance concept,
You're just worried about
the nominal amount
the nominal amount
of capital that
was invested.
like you're not even thinking about inflation.
Right. We're ignoring inflation. It's okay.
But if you're using the purchasing power capital maintenance concept,
Then we're saying, okay,
yeah,
we need to adjust for inflation
yeah,
because we want to make sure that the real value
yeah,
of the capital is maintained.
okay,
So it's about purchasing power.
purchasing power.
Yeah. And then physical capital maintenance,
That's about like
maintaining the productive capacity
productive capacity of the business.
of the business.
Okay.
So can you still
Yeah, can you still produce
the same amount of goods and services?
Exactly.
Even if,
Prices have gone up.
yeah.
Costs have gone up.
So you need to earn enough profit
Yeah.
to be able
Or
to
replace your assets.
replace your assets.
Yeah, and then keep operating at the same level.
Okay.
So it's a different way of looking at profit.
Yeah, it's not just about like the dollar amount.
Great.
It's about what you can actually do.
What you can do with those dollars.
Yeah, with those dollars.
In the future. Yeah.
So all these concepts, like they really,
Are all connected.
they're all connected. Yeah. And they paint this like really complex picture
Yeah.
of accounting.
But it's fascinating.
It's fascinating.
Yeah. Yeah. It's not just
It's not just like
debits and credits.
debits and credits. Yeah,
Yeah.
it's like
There's a lot of
there's a lot more to it.
thought behind it.
Yeah, there's a lot of like theory
Yes.
and judgment.
Judgment, yeah.
And it's constantly evolving.
It's constantly evolving, yeah.
So I think we've done a pretty good job
I think so too.
of like unpacking these
Core concepts.
core concepts.
Yeah.
But the text also talks about some like
Okay.
specific accounting issues.
Specific issues
Yeah.
like real world problems
Yeah.
that accounting theory
Yeah.
needs to address.
Yeah. And I think those are worth exploring
I agree.
because that's where we can really see
Yeah.
how these concepts
Fun
play
to
out
practice.
in practice.
Yeah.
So
Can we tackle those?
let's tackle those
Okay.
in the next part of our deep dive.
Yes, sounds good.
All right.
I'm ready.
Okay, so we're back for the final part of our deep dive into accounting theory.
I'm excited to tackle some of these real world accounting issues.
Yeah, let's get practical.
Let's do it.
So one that we touched on earlier, but I think is worth revisiting, is the treatment of goodwill.
Yes. Goodwill, that intangible asset that can be so valuable, but also so hard to pin down.
Exactly like we said before, it's the value of a company beyond just its physical assets.
It's like the reputation, the brand recognition, the loyal customer base, all those things that contribute to a company's success but aren't easily quantifiable.
Right, it's like trying to put a price tag on a company's good vibes.
You know, it's funny you see that because some people refer to it as like the halo effect.
The halo effect.
But seriously though, accounting for goodwill has been a subject of debate for ages.
Yeah, like should we amortize it over time, assuming it gradually loses value?
Or does it maintain its value, maybe even increase over time, especially for companies with strong brands and solid reputations?
That's the million-dollar question, isn't it?
It really is, and accounting standards have evolved over time to try to address this.
So what's the current thinking?
Well, under International Financial Reporting Standards, or IFRS, goodwill is no longer amortized.
Okay, so we're not just assuming it's steadily declining in value.
Exactly. Instead, companies are required to test it for impairment annually.
So basically they're checking to see if there's evidence that the value of goodwill has decreased.
Precisely. And if there are signs of impairment, they adjust the recorded value accordingly.
It seems like a more realistic approach, recognizing that the value of goodwill can fluctuate.
It is. It's about trying to capture the true economic reality rather than just sticking to a rigid formula.
It makes sense, especially in a business world where intangible assets are becoming increasingly important.
Absolutely. Accounting needs to adapt to reflect these changes.
Okay, so goodwill is one tricky area, but the text also highlights another interesting issue, the treatment of non-monetary grants and gifts.
Oh yeah, those can be tricky too because there's no straightforward cash transaction involved.
Exactly. Like imagine a company receives a land grant from the government to encourage investment in a certain area.
How do you record that on the balance sheet?
It's not a purchase in the traditional sense,
No.
so using historical cost doesn't really make sense.
Right, and in the past, the focus was often on recording these transactions at their nominal value, maybe a token amount, just to acknowledge the asset was received.
But that doesn't really capture the true economic benefit to the company.
Not at all. The thinking has shifted towards reflecting the substance of the transaction, rather than just its legal form.
So we're moving away from just checking the box and towards capturing the real economic impact.
Exactly. The current trend is to recognize these grants at their fair value, which could be significantly higher than their nominal value.
Okay, so we're trying to get a more accurate picture of the company's financial position by considering the true value of these non-monetary benefits.
It's about transparency, fairness, and making sure the financial statements reflect the economic reality of the situation.
It all ties back to that ethical approach we discussed earlier.
Absolutely. Accounting isn't just about following rules, it's about representing the economic truth of a business.
These examples really highlight how accounting theory is grappling with these real-world challenges, trying to find solutions that balance practicality with accuracy and ethical considerations.
It's a constant process of evolution and refinement.
And it's fascinating to see how these theoretical concepts we've been discussing play out in practical situations.
It's what makes accounting theory so dynamic and relevant.
Well, I think we've done a pretty amazing job of unpacking some pretty complex stuff.
I agree. We've covered a lot of ground from the foundations of accounting theory to these specific accounting issues.
I feel like I've gained a whole new level of understanding and appreciation for the complexities of this field.
It's definitely more than just crunching numbers.
So much more.
Oh,
It's about understanding the principles and concepts that underpin those numbers and how those concepts are constantly evolving to meet the challenges of the ever-changing business world.
it's a continuous journey of learning, adapting, and seeking those solutions that best reflect the economic reality.
And to our listeners, we hope this deep dive has inspired you to keep exploring, keep questioning, and keep diving deep into the fascinating world of accounting theory.
It's a field that impacts all of us, and understanding it can empower you to make more informed decisions in your own financial lives.
Thanks for joining us on the deep dive.